Silver. Finally entering the three-digit era, not as a headline, not as a rumor, but as a quiet moment that forced markets to stop pretending. For years, silver was dismissed, too familiar to be dangerous, too controlled to matter. Then something happened that did not fade, did not reverse, did not ask for attention. The price did not spike, it settled. And when a market settles at a level it was never supposed to reach, that is not excitement, that is information. Some noticed the number, few noticed the behavior. Because when silver enters three digits, it is never just about silver. It is about who stopped selling, who started paying, and what the system is trying not to say out loud. It is a warning story. And by the time the meaning becomes obvious, the cost of ignoring it will already be locked in Welcome to Economy revelations. This channel speaks to those who have lived through cycles, who remember when prices were stable and who know that markets whisper long before they shout. If you are above 50, someone who has seen inflation come and go, who has watched systems reset without warning. This is a conversation worth staying for. The channel invites viewers to subscribe, not for excitement, but for clarity. And before continuing, viewers are invited to leave a comment sharing where they are watching from, because moments like this are never local. For decades, silver occupied an uncomfortable place in global markets. It was valuable, but not urgent. Useful, but not threatening. It moved, but rarely demanded attention from decision makers. When prices rose, they were explained away. When prices fell, they were ignored. Silver was treated as a market that reacted, not one that led. That assumption quietly ended when silver crossed into three-digit territory and stayed there long enough to change behavior. This was not an intraday spike driven by headlines or leveraged speculation. It was not a brief moment of excitement followed by a retreat. The price held. More importantly, transactions continued to occur at that level. Sellers did not rush back in. Buyers did not step away. The market accepted the number. In economic terms, acceptance matters more than movement. A price that is touched can be dismissed. A price that is defended must be explained. Historically, silver's price ceiling was reinforced by habit rather than reality. Analysts repeated old ranges. Models assumed mean reversion. Institutions treated higher prices as temporary distortions rather than signals. This worked as long as the underlying structure remained intact. But structures do not break loudly. They bend quietly, then fail suddenly. The three-digit price forced a reassessment because it challenged multiple assumptions at once. It challenged the belief that silver supply was flexible. It challenged the idea that paper markets could indefinitely control physical outcomes. And it challenged the notion that industrial demand could be easily deferred. What made this moment different was not the number itself, but the absence of relief. In previous rallies, higher prices brought selling pressure. This time, higher prices brought urgency. Buyers paid premiums rather than waiting. Delivery mattered more than price improvement. That behavioral shift signaled stress that charts alone could not explain. Markets often reveal stress through secondary indicators before headlines catch up. In this case, premiums widened. Delivery timelines stretched. Inventory drawdowns accelerated. These are not speculative signals. They are operational ones. They appear when supply is tight and substitution is limited. Silver is not a luxury input. It is embedded in electronics, energy systems, medical equipment, and infrastructure. When its availability becomes uncertain, planning becomes difficult. When planning becomes difficult, businesses pay to remove uncertainty. That is how prices move without drama. The three-digit price also disrupted the narrative framework used to dismiss silver. For years, price increases were labeled as sentiment-driven or speculative. That explanation failed when the move persisted across regions and settlement periods. Speculation fades quickly. Physical demand does not. Another overlooked aspect was timing. This move did not occur during a single crisis or announcement. It emerged during a period of apparent normalcy. That made it more dangerous. When markets reprice during calm conditions, they are responding to pressures not yet visible to the public. For business leaders, this is where risk often hides. Loud crises demand attention. Quiet repricings are easier to ignore. Yet historically, it is the quiet repricings that reshape cost structures, supply chains, and competitive advantages. The silver market did not ask for permission to change. It did not wait for confirmation from policymakers or analysts. It simply adjusted to realities beneath the surface. Those realities include years of underinvestment in supply, rising industrial intensity, and increasing competition for physical material. This is why the three-digit era cannot be treated as an anomaly. It represents a point where legacy assumptions stopped working. Once that happens, markets rarely return to the old narrative. The price was not the story. The acceptance of the price was. The most common mistake made during moments like this is to search for a single cause. Markets rarely move because of one reason. They move when multiple pressures align quietly enough to escape attention, yet powerfully enough to force adjustment. Silver's transition into a 3-digit price zone was not triggered by excitement. It was triggered by mechanics. To understand those mechanics, one must first separate silver into what it actually is, not how it is usually discussed. Silver is not just a metal traded on screens. It exists in 2 parallel markets that behave very differently. One is liquid, fast, and abstract. The other is slow, physical, and unforgiving. For years, the abstract market dominated price discovery. Contracts changed hands many times without the metal ever moving. As long as the system functioned smoothly, price remained contained. That containment depended on one assumption, that physical silver would always be available when needed. This assumption began to weaken long before prices reacted. Industrial demand for silver is not optional demand. It cannot be postponed easily, and it cannot be replaced without cost. Modern technologies rely on silver's conductivity, reliability, and efficiency. Each incremental use may appear small, but aggregated demand compounds steadily. Unlike investment demand, industrial demand does not retreat when prices rise. It adapts by paying more. At the same time, supply flexibility eroded. Mining output did not expand meaningfully, not because resources disappeared, but because capital allocation shifted elsewhere. Silver is often produced as a byproduct. When primary mining activity slows or shifts, silver supply tightens regardless of its own price. This creates a lag that markets routinely underestimate. Paper markets can absorb this imbalance for a while. They do so by expanding claims rather than material, but claims only work as long as settlement pressure remains low. When more participants choose delivery over rollover, the system is tested. This is where premiums become critical. Premiums are not opinions. They are costs paid above reference prices to secure actual material. When premiums widen persistently, they indicate that the reference price no longer reflects availability. In recent periods, buyers paid those premiums without hesitation. That behavior revealed urgency. Urgency changes market physics. In a normal environment, buyers wait. They negotiate, they optimize. In a tight environment, buyers act, they secure, they accept inefficiency to avoid disruption. That shift is subtle, but it is decisive. Another overlooked factor was geography. This was not a localized event driven by one exchange or one region. Pricing pressure appeared across multiple markets with different participants, regulations, and incentives. Coordinated behavior without coordination suggests shared constraints rather than shared sentiment. It is also important to understand what did not happen. There was no widespread speculative frenzy. Retail participation did not dominate flows. Media coverage lagged price action rather than leading it. These absences matter because they remove common explanations. When familiar drivers are missing, structure becomes the answer. As physical demand asserted itself, price discovery migrated away from leverage and toward settlement. This does not require conspiracy or failure. It requires only that enough participants value certainty over optimization. Once that threshold is crossed, prices re-anchor. 3-digit silver was not the result of buyers believing silver was worth more. It was the result of buyers needing silver more. This distinction matters for decision makers. Belief-driven prices are reversible. Need-driven prices are sticky. The paper market can signal comfort long after the physical market has become stressed. That delay creates false confidence. By the time paper prices adjust meaningfully, physical behavior has already changed. This is why the 3-digit level appeared sudden to observers but inevitable to participants on the ground. Another critical mechanic was time. This repricing occurred not during panic, but during routine operations. That suggests adaptation rather than reaction. Adaptation implies permanence. Markets do not reward awareness. They reward preparation. By the time a price becomes widely accepted, the opportunity to adjust cheaply has passed. Part 2 makes one point clear. Silver did not become expensive because of excitement. It became expensive because availability became uncertain. And when uncertainty enters the supply chain of a foundational input, price is no longer the primary variable. Continuity is. That shift marks the true beginning of a new era, not defined by numbers on a chart, but by how markets behave when the old assumptions stop working. Markets rarely announce when they cross a boundary. They simply begin to behave differently. In the case of silver, the most important change was not its price, but its role. At 3 digits, silver stopped behaving like a typical commodity and began acting like a systemic signal. Commodities usually respond to cycles. Demand rises, supply reacts, prices normalize. That rhythm allows businesses to plan, hedge, and wait. Silver disrupted that rhythm. Instead of responding, it began to lead. And when an input begins to lead rather than follow, it transmits pressure outward. The first pressure appears in trust. Modern financial systems depend on the assumption that markets intermediate smoothly between buyers and sellers. When physical settlement becomes difficult, that assumption weakens. Participants do not panic immediately. They adjust quietly. They shorten timelines. They diversify suppliers. They accept higher costs to reduce exposure. Each adjustment is rational on its own. Together, they reshaped the system. Silver's repricing exposed a gap between financial representation and physical reality. Paper instruments continued to suggest liquidity. Physical channels suggested constraint. When those two diverge, confidence erodes, not dramatically, but persistently. This erosion matters because silver sits at the intersection of multiple critical sectors. It is embedded in energy transition infrastructure, data transmission, healthcare equipment, and defense systems. These sectors do not operate on speculative timelines. They operate on delivery schedules. When input reliability is questioned, entire project frameworks are reassessed. The next pressure appears in margins. For manufacturers, silver is not a discretionary input. It is engineered into products. Replacing it often reduces performance or increases complexity. When prices rise structurally, margins compress unless costs are passed through. Passing through costs requires pricing power. Pricing power is uneven. Smaller firms absorb pressure first, larger firms delay. Eventually, the pressure reaches consumers or taxpayers. This cascading effect is rarely attributed back to the original input. Instead, it appears as general inflation, project delays, or capital overruns. By the time it is visible, the cause is already behind the curve. Another implication is currency signaling. Historically, precious metals reprice when confidence in purchasing power weakens, not because they are alternatives, but because they are references. Silver's movement signaled that something measured against currency units was changing. That change does not require currency collapse. It requires only sustained dilution and rising substitution costs. For entrepreneurs and business planners, this signal is critical. It suggests that nominal stability may conceal real instability. Revenues may rise while real margins shrink. Balance sheets may grow while purchasing power erodes. Silver's repricing acts as a measuring stick against these distortions. There's also a behavioral implication. When an asset long treated as secondary becomes central, it forces reclassification. Analysts update models. Risk managers adjust scenarios. Procurement officers renegotiate terms. None of this happens at once. It unfolds unevenly, creating temporary advantages for those who adjust early and structural disadvantages for those who wait. Silver ADRS 3-digit era also challenges the assumption that systemic stress always appears first in equity or bond markets. Sometimes it appears in materials that sit beneath those markets. Inputs reveal pressure before financial assets reflect it. This is why dismissing silver as a niche story is dangerous. It ignores its role as a transmission mechanism. When silver reprices, it affects energy costs, manufacturing timelines, and infrastructure budgets. These effects compound quietly. Another overlooked implication is policy lag. Regulatory and policy responses trail market signals. By the time officials acknowledge structural changes, markets have already adapted. Businesses that wait for guidance often find themselves reacting to conditions rather than shaping outcomes. Part 3 is not about predicting collapse. It is about recognizing signals. Silver did not move to 3 digits to make a statement. It moved because the system required it. That requirement exposes stress points that extend beyond one market. When a metal stops behaving like a commodity and starts behaving like a constraint, it changes how risk travels through the economy. Those who understand this do not ask whether prices will fall back. They ask what assumptions no longer hold and what must be rebuilt in response. Because once a system reveals its pressure points, it rarely returns to its previous equilibrium. When a market reaches the final stage of repricing, the most dangerous response is hesitation disguised as patience. Decision makers often believe they are waiting for confirmation, when in reality they are waiting for permission. Silver's entry into a 3-digit era removes that permission structure. It signals that the environment has already changed. This final part is not about forecasting prices. It is about adapting behavior. The first adjustment is interpretive. Leaders must stop asking whether silver is expensive and start asking whether availability is stable. Price is visible. Stability is not. Yet stability determines planning, not price. When availability becomes uncertain, even a lower price carries higher risk than a higher price with reliability. Businesses that understand this shift move differently. They shorten planning horizons where inputs are uncertain and lengthen them where supply can be secured. They treat inventory not as idle capital but as insurance. This reframing runs against decades of efficiency-driven doctrine, but efficiency fails when continuity is threatened. And the second adjustment is structural. Many risk models assume commodities revert to historical means. Those models work in environments of surplus and substitution. They fail in environments of constraint. Silver's behavior demonstrates that some inputs are entering a phase where structural demand meets inflexible supply. In such cases, reversion is not a strategy. It is an assumption. Executives who continue to price contracts, bids, and long-term obligations under old ranges embed future losses into present decisions. These losses do not appear immediately. They surface later as margin erosion, renegotiations, or failed delivery commitments. The third adjustment is strategic positioning. Not every business is equally exposed. Some use silver directly. Others depend on suppliers who do. Exposure can be direct, indirect, or hidden within complex supply chains. Understanding where silver appears is no longer optional. It is a form of risk mapping. Once exposure is identified, optionality becomes valuable. Optionality does not mean speculation. It means preserving the ability to act under changing conditions. This may involve diversified sourcing, flexible product design, or alternative procurement timelines. Each option carries cost, but that cost must be compared to the cost of disruption. Another critical adjustment concerns capital discipline. In stable environments, capital is allocated to maximize return. In unstable input environments, capital must also protect continuity. Projects that appeared viable under old cost assumptions may no longer be resilient. This does not mean halting investment. It means recalibrating expectations. Entrepreneurs often underestimate this phase because it lacks drama. There is no single announcement that declares a new regime. Instead, small adjustments accumulate until they redefine competitive advantage. Firms that adapt early absorb higher costs but gain reliability. Firms that delay preserve margins temporarily but inherit volatility. There's also a timing lesson. Markets reward those who act when signals are unclear, not when conclusions are obvious. By the time official narratives acknowledge a structural shift, pricing power has already redistributed. Those who waited for certainty often pay for it. Silver's three-digit era is best understood as an early chapter, not a climax. It suggests that input repricing may spread unevenly across materials, regions, and sectors. Each repricing will look isolated until it is viewed in aggregate. For decision makers, the question is not whether silver will remain at this level. The question is what other assumptions share the same fragility. Strategic leadership in such environments requires humility. Models must be questioned. Comfort must be challenged. Past success must not be mistaken for future security. The final insight is this: markets do not send warnings in plain language. They send them through behavior. Silver's behavior has changed. Those who treat it as noise will react later under pressure. Those who treat it as information will adapt quietly and early. In every economic transition, there's a moment when the cost of preparation is lower than the cost of explanation. Silver's three-digit era marks that moment. The choice, as always, belongs to those willing to see it.